5 minutes away from the opening bell this morning. Good morning to you. Basically where we were this time yesterday. Futures just a little bit softer in the face of some weak economic data. Here stateside, that was Empire Manufacturing yesterday, and we still squeezed out a day of gains. Futures right now down about 1/3 of 1% on the S&P 500. As the price action, here are your morning calls. Daiwa upgrading PayPal to outperform 116 price target, saying the payment sector is poised for higher growth in the long term. Our stock is positive about 1/2 of 1%. Next up, Citi downgrading Zoom Video to a sell, $91 price target, highlighting new and upcoming obstacles to sustainable growth. Our stock is down by almost 4% at 108.80 in the pre-market. And finally, B. Riley downgrading Bed Bath & Beyond to a sell, seeing an unrealistic valuation after jumping 50% in the past 2 sessions. That stock negative 1.6%. Coming up, he said to buy stocks on what ended up being the lows of the year. Now he's saying to lock in some profits. We'll catch up with BNP Sam Linton-Brown at the opening bell next.
This is Bloomberg.
24 seconds away from the opening bell in New York City this morning. Good morning to you all. You know the numbers by now. Up 17% off the lows on the S&P, up about 23% off the lows on the Nasdaq 100. And on the S&P, taking out more than 50% of the drawdown from the high to the low of the year so far. And the S&P futures slightly negative going into the opening bell. That is your opening bell. Switch at the board and get to the bond market. Yields drifting a little higher this morning, at 3 basis points on a 10-year to 282. Euro dollar giving me nothing, 101.60. totally unchanged. And crude down about 0.8%, $88, and let's call it 77 cents. That's the cross-asset price action with your movers. Here's Abby.
John, well, let's start out with the big earnings winner today, and that, of course, is Walmart. But what's so interesting, they, of course, as you know, beat earnings estimates, but it was a low bar quarter. They've basically thrown in the kitchen sink a few times this year. And to give you an idea, they're now looking for down 9 to 11% earnings decline, not even growth, but investors are cheering that because the outlook had been so grim before. Chevron is up about 0.4%. This, of course, oil had been a little bit higher before, kind of recovering now down, but Chevron still higher. Alcoa up 2.2%. And then finally, Home Depot off of its lows, up ever so slightly right now. The good news is there, they beat. The bad news, transaction and traffic down into today, up 16% from that June low. On the year, down 24%. It'll be interesting to see how Home Depot finishes out the day, John.
Some good numbers for Walmart, at least, and some good news for investors there. That stock up by more than 5% in the first minute or so of trading. Taylor Riggs back for a second look. Hey, Taylor.
John, you're right. So let's talk about some of the U.S. comps. Some of these same-store sales are up about 6.5%. Yes, that was an improvement here relative to expectations. Revenue, as we talked about, also up about 9%. So tracking inflation, and the average ticket, as you mentioned, also up about 5.5%. I think, as you mentioned in the previous segment, some of the real key issues that you're seeing as a CEO, middle and high-income shoppers coming into your store. How are you balancing some of the pricing power versus gaining market share, like they're saying within the grocery business, even though it is a little bit of a lower margin business? Let's talk about those margins actually holding up. And I think what's interesting is you got on the call a lot of commentary about maybe people pivoting more towards groceries. That is that lower margin business, less money if you're a consumer who's pinched for some of the apparel and the higher margin businesses. But this is a company that really is managing to do it. And this margin story continues to show that they're holding up their own worth here. There has been some underperformance, though, relative to the staples sector. If you think about where we are year to date in the last year, trying to recover some of those gains this morning, as you see. But again, the cuts and the guidance cut coming into this report, really some of the big underperformances of late.
Hey, Taylor, it's been hard to trust the guidance. Can we put it that way? Is that diplomatic enough? Is that too blunt?
I like it.
It's been hard to trust the guidance.
Set the bar low and you always beat it.
Exactly. And then they come out a couple of weeks later and then they have to cut again, seemingly, which has been the story for the likes of Target and Walmart. Taylor, thank you. Some good news from those retailers that we didn't get cuts to those guidances. On the energy, is that a word? Whatever. Anyway, energy. On the energy front, yesterday we were struggling. Energy right now up 0.7% on the S&P 500. So that's a bounce back from where we were yesterday morning. Real estate struggling, down 0.6%. The S&P softer by just 0.1%. We are now at the tail end of earnings season. Putting it all together, here's Kelly Lyons. Hey, Kaylee.
Hey, John. Well, as you and Taylor were just saying, the bar was pretty low, and that meant that earnings season actually has been pretty solid for this equity market. Yes, we're up 17% off the lows of June, but 14% almost of that gain has actually come since JP Morgan kicked things off a little more than a month ago. If I had to pick a theme for it, it would be just less bad than feared. 92% of the companies have reported thus far, and profits are up about 8.7% overall, beating expectations by 4.1% on average. Now, the surprises on the top line haven't been quite as large, only 2.8%, but the growth has been more substantial. We're talking more than 14% overall, which is likely a byproduct of inflation, because when prices are higher, you just have more money coming in the door. It doesn't necessarily translate down to profitability. And as for the market reaction to these reports, average post one-day earnings move of about 0.1%. What's interesting, though, John, is even companies that missed estimates have gotten rewarded, up about 0.6% after disappointing reports. And that is something that rarely ever happens. Usually the punishments for missing are much larger than the rewards for beating. So that may be a sign that a lot of the bad news was already priced in coming into the reports, or maybe investors are just a little more forgiving this quarter than they usually are. The question is, will that forgiveness continue as we look forward into the current period, especially as you have the likes of Mike Wilson at Morgan Stanley warning about more serious margin pressure coming in the back half of the year, John?
Kelly, thank you. Kelly Lyons. They're looking for that weakness in the back half of the year. I keep going back to Chris Harvey of Wells Fargo, who on this show said maybe it's still too early to expect that weakness to come through for corporate America anytime soon. He's looking for the front half of 2023. And for that reason, he was a little bit more constructive on this equity market run we've had. Wall Street, as you know, has been clashing over the fate of equity gains over the last 2 months. Are the recent gains anything more than a bear market rally?
a 50% retracement of the sell-off.
Maybe this rally has a little bit of legs to it.
As inflation is easing, it's giving the Fed more wiggle room.
Any pricing for dovish pivots from central banks is a bit too premature at this point.
It's hard to see how markets can continue rallying.
You could see this, what I view as a bear market rally, continue.
I'm on the buy into it side.
We're not in a new bull market yet.
4,300 will likely continue to be a resistance.
Risk assets are still quite at risk.
We just need to see more data.
We're in the zone of peak hawkishness. A hard landing is not a predetermined fact. This isn't a bad level to be positioning low-risk assets.
At the end there, on June 16th, that was BNP Paribas' Sam Linton-Brown on this program, telling investors to buy stocks at the lows of the year on the S&P 500. And I started to push back, and I'm pleased to say that he can push back now. Sam Linton-Brown joins us on the phone. Sam, awesome to have you with us on the program. Let's go straight there. June 16th on this show, you said buy stocks. Stocks have ripped, up 17% on the S&P 500 since then, up almost 23% on the NASDAQ 100. Give me the what now. What now?
Well, first off, thank you, John. That's a very generous introduction. Looking ahead, our view from here is more balanced. We're still moderately bullish. That's because positioning is still short, and we think we're very much in the zone to see peak hawkishness in motion, and these factors are supportive. But given how far and fast we've already rallied, we think it's prudent to take some profit here and selectively add some hedges. A key point is also that valuations have normalized somewhat. For example, if you look at the S&P, which you were just referring to, 1 year forward price to earning multiples are at about 18 times at the moment, which is towards the top end of the 30-year range when you exclude some of the bubble periods. And being towards the top end of a valuation range during a downgrade cycle might make it quite challenging for the recent pace of recovery to persist. So on balance, we're still moderately bullish, but only moderately from here, and we'd advocate it's more a case of staying long, selectively adding some hedges, rather than adding to risk on here.
Sam, it wasn't just equities that you were bullish on. You were bullish US stocks in the face of some real trouble at the time. You liked the Aussie in the face of a slowing China. That trade delivered. You liked European banks in the face of a European recession. They've started climbing. Sam, can you be specific about what you would fade within the equity market and where on a geographic basis too?
In the short term, the risk in the US is probably more geared towards some fears around growth, as in economic growth rather than the growth sector. And that suggests some of the lower quality portion of the value spectrum, i.e. Russell 2000, could be set for a bit of a retracement. So we like adding some put spreads there, so some sort of range-bound selective downside hedges. In Europe, you mentioned the bullish financials call. We did have that. Banks have bounced somewhat. Going forward, the view we've got there is that it will again be a little bit more balanced. The European economic backdrop has deteriorated quite significantly. H1 was better than anyone thought. H2 we think might be worse than people expect. So we back away a little bit from the bullish banks call. And then energy is a sector we like both in the US and Europe. To bring it over to currencies, as you mentioned, the Australian dollar, we're still bullish there. The way that we think one should be positioned in the foreign exchange market is to position short the euro and euro correlated proxies like the pound, like the Czech krona, like the Polish zloty, and positioned against that more commodity sensitive currencies like the Australian dollar, like the Norwegian krona.
Sam, is that a view on how much work the ECB can do, or just a general view on how much weakness you expect in the European economy?
The ECB, we think they will actually be tightening even into what's highly likely to be a recession, and that's because inflationary pressures right now are very strong, and in contrast to the US, they will get stronger over the coming months. So we think the ECB deliver 50 bips at its next meeting, then downshift the pace to 25, given the growth concerns, but it's still 75 bips more tightening from here, with then a pause as they wait to see how growth data evolves. In terms of the rates impact of that, we actually think it means core yields in Europe can still reprice a little bit higher. So we like to sell 10-year bonds, targeting a move to 120 basis points. The position the team added at 75 basis points. They still think there's some further scope there. Banks, though, will be challenged, even though yields are rising, with the fact that the reasons they are rising is more about inflationary concerns in Europe rather than a stronger growth backdrop.
Sam, awesome to catch up. I know we had some problems with the line, and hopefully next time we can re-establish the connection and get a clearer line with you so we can catch up again. Sam Linton-Brown on the show June 16th, pushing back, saying buy stocks, and we've had quite a rally since then, and now we're starting to get a more nuanced view about what to do with the recent strength. Just going through Sam's recent notes, and I'll bring you the quote. There is some scope for continued gains. Rallies will not be as fast or large as we have already seen, and striking some shallow hedges may be appropriate. Our targets from here are still moderately higher, i.e. 4,400 on the S&P, but the risk-adjusted return from current spot is not particularly attractive. The view from BNP, I remember a few weeks ago BNP talked about the prospect of crowding in investors because so many people were so bearish. Bank of America have got a fund manager survey. I'm going to break that down for you in just a moment, but here's the quote that jumped out for us from B of A. Sentiment is still bearish. Cash is at 5.7%. Too bearish for immediate reversal of the bear rally. They remain patient bears. That's Michael Hartnett over at BFA. And they would fade the S&P at 43.28 as rates up, profits down is the base case. Just as far as the S&P is concerned at 43.28, we're basically there on the money right now at 42.91. We're not far away. We're about 11 minutes into the session. We're down a tenth of 1% on the S&P. On the Nasdaq, we're down about 0.4 of 1%. Coming up, we'll cover that Bank of America Fund Manager survey and why they see investors as no longer apocalyptically bearish.
There was a massive swing in sentiment. I think that coupled with that perception that the Fed became a bit more perhaps dovish led to the rally that we've seen.
The conversation. I'm next.
The market narrative shifted a bit, and that lower vol regime is positive for risk assets. And especially, it's more positive when sentiment had gotten so far offside. So there was a massive swing in sentiment. I think that coupled with that perception that the Fed became a bit more perhaps dovish led to the rally that we've seen.
That was Lisa Hornby of Schroders. Always great to catch up with Lisa. About 15 minutes into the session, we shape up as follows. On the S&P 500, down about 0.1%. Consumer staples leading the way up 0.8%. Home Depot, Walmart doing okay, considering the cuts to guidance we've seen from some of these big retailers over the last few months, year to date so far. Consumer discretionary up by 5 or 0.6%. I mentioned a weakness in energy this time yesterday. Just a little bit of a bounce here, some strength, up 0.4% on energy. Information technology lagging, down 0.6%, so about 16 minutes in, it leaves us here, down 0.1% on the S&P. On the Nasdaq, down about 0.4%. And one of my favorite pieces of research every single month, the Bank of America Fund Manager Survey with Michael Hunt and the team, and it reads as follows this morning. Sentiment still bearish, but no longer apocalyptically bearish, with cash at 5.7%. Too bearish for immediate reversal of the bear rally. We remain patient bears. We would fade the S&P above 43.28 as rates up, profits down is the base case. Did you get all of that? Katie Knights has more. Hey, Kaylee.
I love that. Not so apocalyptically is a very hard word to say, bearish. As for what they're seeing in the survey that indicates to them that that is indeed the case, it's the fact that after the record lows on growth expectations and stock allocation that we saw in July, both of those things went up, albeit from relatively depressed levels. And the same thing was true for cash. You saw that drop down to 5.7%, as you said. That is still relatively elevated, but it's lower than the 6.1% allocation of last month. So a lot of this seems predicated on the hope that inflation and rate shocks are going to come to an end soon. You can see that reflected in 88% of those surveyed now expect lower inflation in the next 12 months, though still positioning overall remains in what they're calling long stagflation. Part of that has to do with the high cash levels as well as commodities and defensives that show positioning is still leaning that way. As for the most crowded trades, coming in at number one is long U.S. dollar, followed up by long commodities, long cash, which I mentioned, and long FANG stocks coming in here as well. On the short side, that would be the Treasury call. And as for the biggest tail risk, inflation is still at the top, followed by a global recession and hawkish central banks. But I wonder how much we will see that change in the surveys going forward, John, as the narrative seems to be shifting toward this dovish pivot. And finally, systemic credit events and a COVID-19 resurgence make the list as well.
Katie, thank you. Great breakdown. Wonderful piece. Always enjoy reading it. Just on that crowded trade for short treasuries. Treasuries lower today, yields higher by 5 basis points on a 2-year to 3.23, on a 10-year up about 7 basis points this morning to about 2.85. That's the bond market. Let's talk about 13Fs. The latest findings showing Tiger Global and Soros piling into big tech, bolstering stakes in companies like Alphabet and Amazon and benefiting from the tech stock rally. Let's get you some more. Here's Abby.
Well, John, it is that time of the quarter when we get to find out what the biggest institutional investors did in the previous quarter. And as you were just mentioning, Tiger Global and Soros Fund piling into tech. Now, relative to Soros Fund, it's pretty impressive. Amazon, Salesforce, Qualcomm, Tesla, Alphabet, no fear there. Those stocks that had been so beaten down, buying that dip. On the other hand, it's interesting to see that what they sold, a lot of it having to do with EV and wheels. Fisker, Uber, Rivian, cutting all of those stakes. As for probably the most awaited filings each quarter, that of course is Berkshire Hathaway, Warren Buffett's firm. You can see that they continue to buy. Now, in 2008, Warren Buffett said that when others are fearful, that is the time to be greedy, and when others are greedy, that's the time to be fearful. Well, there was a fair amount of fear in this last quarter, John. You can see that Warren Buffett's Berkshire Hathaway loaded up on Occidental Petroleum. There's some thought that the position there is so large that they may, in fact, at some point buy out that company. Ally Financial, Activision, Apple, and then more broadly, this is very interesting because, of course, it's this difficult year, this debate whether or not we're still in a bear market. Well, the sectors that were most bought, healthcare, consumer staples, energy, and utilities. 3 of those 4 sectors, John, as you know, are defensive sectors. The only 2 sectors this year that are higher, energy up 40%, 39%, and utilities up 8%. That's where the hedge funds went. But again, that's not the most bullish picture because those are all defensive sectors with the exception of energy, which just continues to be higher and higher.
Absolutely. Abby, what do we make of 13Fs? I'm conflicted. I like getting the snapshot, but so much of it's dated, and I don't know what to do with it.
Yeah, it's interesting. I think maybe it's a little bit more of a media thing in a way, in terms of seeing what these big investors did. A lot of these investors, as you know, have these big personalities, so it's curious to see what are they doing. That said, some of these stocks, when the report comes out in terms of a big position taken, especially a new position or a big ad, you'll see those stocks do very well because retail investors want to pile in, and I suspect maybe some of the smaller institutional investors as well.
Abby, thank you. Less conflicted, more diplomatic than me about 13F filings. About 20 minutes in, equities down 0.25% on the S&P 500. Talked about where the weakness was concentrated in big tech, information technology, leading some of the declines there, some of the big names. The Nasdaq is down by about 0.6%. From DC with a bit of news, it's Anne-Marie. Let's get over to her now. Hey, Anne-Marie.
Good morning, John. Yeah, we got some news from CBS that this judge is going to have a hearing at 1 p.m. on Thursday, so 2 days from now, about what is going on in terms of the former president's case. Now what we heard from the Justice Department overnight, there's a lot of questions regarding the affidavit. Should they not release the affidavit the same way they released the warrant? And what the Justice Department said is that they do not want to go ahead with releasing the affidavit because they believe this could be potentially an issue with witnesses in terms of the investigation, and they don't think it is safe at this moment to do so. But there is going to be a hearing, and what we need to remind everyone is that it really is up to the judge in whether or not they want to release that affidavit. It's a very unprecedented time, and there's been a number of conservative groups and media groups who have asked, given the fact that this is a very unprecedented situation, to release that affidavit to give more information on why there was this raid in Mar-a-Lago and potentially why the former president had these 11 sets of classified information.
MH, how is the current president navigating this? What's the White House response to all of this as it continues to build over the last week?
It's very much so mum. They do not want to get involved. They say that they are not briefed on the matter. They are not going to comment on the matter. This has to do with the Department of Justice, the FBI. These are independent institutions, and they are really making sure they are careful in terms of how they discuss what is playing out, obviously, across the media.
Anne-Marie, good to catch up, as always. AMH with the latest down in DC. I know you're all following that story. When we get some headlines on it, I'll bring them to you. Or rather, Anne-Marie down in Washington, DC will bring them to you. No doubt through the day, keeping you up to speed on Bloomberg TV and on Bloomberg Radio. Coming up, the market moving events you need to be watching. Your trading diary is coming up next. On the horizon, some Fed minutes and US retail sales. We'll break it down for you next. This is Bloomberg.
even if you were at 3.8 with inflation still well above target, around 8%, falling only gradually, core inflation around 6-ish, you're still in negative territory. So the Fed funds rate should be going well above 4%, 4.5% to 5% in my view, to really push inflation towards 2. If that doesn't happen, inflation expectations are going to get unhinged. Or if that happens, then we're going to have a hard landing. So either way, either you get a hard landing or you get inflation getting out of control.
It's one way or the other. That's your dose of gloom from Nouriel Roubini. It's either a hard landing or runaway inflation. That's his view. It's not mine necessarily. Futures were negative going into the open, inbound coming out the other side of the open about 25 minutes into the session. Cash equities open up and we're down about 0.1% on the S&P. We're down 0.6% on the Nasdaq 100. Keep an eye on what's happening in the bond market. 2s, 10s and 30s. Yields just starting to pick up at 7 or 8 basis points on a 10-year to 286.21. That's the price action. Here's your trading diary. President Biden signing the Inflation Reduction Act at 3:30 Eastern. US retail sales and Fed minutes coming up tomorrow, plus retail earnings continue to roll in. Lowe's, Target and TJX on deck. The Fed's Esther George and Neil Kashkari speaking on Thursday, followed by existing home sales and another round of jobless claims in America. So a ton of data still to come. From New York, thank you very much for choosing Bloomberg TV. For our audience worldwide, this was the countdown to the open. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day on this Tuesday, August 16th. Here are the top market stories that we're following for you at this hour. Not catastrophically bearish. Bank of America's Fund Manager Survey shows investors feel a little bit better and cut their equity underweight to less bad. Cash, though, still king. And Walmart could have been worse. The company beats on already lowered profit estimates, giving us the latest read on the consumer. Housing, though, is worse. Starts fall to the lowest level since early 2021 as higher rates eat into demand, while Home Depot warns of weaker transactions. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, it feels a little similar to the conversation from yesterday as well. Like the data continues to roll in poorly, but some equity areas of the equity market still hold up relatively well despite higher yields.
Yeah, it's interesting. So let's take Walmart as a case in point. In many ways, Walmart shouldn't be trading in the way that it is today. I think the buybacks have got a lot to do with it. They are buying back a ton of paper right now, and that probably sends a fairly positive signal about their view of the economy going forward. But they did cut guidance. They've beaten that guidance, that lowered guidance, and the market responds positively. Kind of feels very circular to all of this, doesn't it?
It does.
The housing data as well, Alex? Yes, the headline number was bad, but the prior number was revised and the permits looks good, or better. Could have been worse.
And kind of the same thing for Home Depot.
There's a kind of silver lining.
So the transaction is lowered, but, you know, it wasn't terrible.
Yeah, but that's kind of, it's not terrible enough to justify the kind of rally that we've been seeing in equities. That's my question. That's the bit that I can't get my arms around at the moment. The market's really split on this rally, still can't make up its mind. We're still in earnings season, we're still getting numbers coming through. I think the consumer is really important. So actually this latter stage of the earnings season I think is really critical in terms of getting an idea of what's happening with the macro story. The housing data, yeah, I think probably in aggregate it was a little bit more bearish. Yesterday we spoke to Michelle Meyer, of course, chief US economist at MasterCard Economics, the MasterCard Economics Institute. She was talking about what's happening in housing. She was talking about what was happening with the consumer.
The housing market is under the most amount of pressure. That's where you have the biggest impact from interest rates. That's where you've seen, you know, in some sense, a post-pandemic adjustment where you had so much of a concentration of housing activity after the pandemic first hit, and that probably pulled forward activity away from, you know, the current environment.
So that brings us to our question of the day. How bad is housing? How bad could housing get? Let's ask that question to Yelena Shulyatyeva, senior US economist here at Bloomberg Economics, and Drew Reading, who covers home builders for Bloomberg Intelligence. Yelena, let me start with you. How bad was that data? What does it tell us about what is happening in the housing market and where the housing market is going?
The housing market has just one direction to go to at this moment. I think it's going to be down, and we'll see further negative news. So it's not just a demand story, Guy, it's also a supply story. So if you look at housing starts for sale, this is the quarterly data also reported today. We only get it once in 3 months. And this is called housing starts for sale. They're still running way above at 160,000 annualized units than new home sales, which are barely above 700,000. So I'd say that we have plenty of inventory, and there's plenty of inventory to come. There's a lot in the pipeline. Those units still need to be completed. So you're not only getting hit on the demand side with higher mortgage costs, but also on the supply side.
Drew, we have seen, though, housing completions still hold up. I wonder how long that lasts, and then what the companies do after that. How do they retrench?
Yeah, you're right. Completions are finally starting to inflect higher, and that's the response builders have taken to taking their foot off the gas pedal in terms of starting new products and rather completing the ones that have been under construction. You have to remember that during the pandemic, supply chains were so constrained that it was taking, you know, several months in some instances to get a house completed. So we're just starting to work through some of them. And that's actually one of our main concerns, you know, through the remainder of this year and into next year, is that there's a lot of late stage inventory in the new home market that's going to come to market over the next, rest of this year and into early next year. We think that's one of the reasons that home builders are going to have to increase their use of incentives to get sales paces to a desirable level. But to your other point in terms, how do they adjust to this market? One, you're seeing builders pull back on starts in a direct response to demand, but you're also seeing them dial back their land purchases. A lot of the group that we cover has the land they need for this year and next, so you're starting to see them take their foot off the gas pedal appropriately, given where demand is at.
Drew, is this a rational management of a situation? We've seen the housing market crank before and everything go to hell in a handbasket really quickly. Presumably lessons have been learned. Are we going to see a more managed slowdown if we are going to see the slowdown that Yelena talks about? Is it going to be controllable?
Yeah, so I think something that's different this time around is that builders are actually acknowledging, earlier in this process that demand is slowing, and they're taking the appropriate actions within their business to kind of adjust to the new demand environment that we're seeing, compared to cycles in the past where it was growth at all costs, and you're buying land and putting new products in the ground up until you actually get to the recession. So the fact that they've kind of acknowledged what's happening in the market, I think, is a little bit different, and they're taking the appropriate steps.
Nevertheless, Yelena, I'm wondering what the read-through from the housing data will be to GDP. Like, is this good for the Fed? Does this help the soft landing? Or if the speed is sped up, as we were just talking about, does that mean it's going to work against the Fed?
Well, look, housing, residential investment will subtract from GDP this year. And we're expecting just a slightly positive reading on GDP for the year as a whole. But I think that we will be able to avoid that sort of a crash that we saw back in the financial crisis from the housing market, just simply because consumers have a little bit more of a safety net this time around. So they have more, equity in their properties. They have less debt, so they should be able to weather it much better this time around.
Drew, there's been a lot of movement within the US housing market in terms of where population has gone to. Where is probably most exposed right now? Is it traditional markets like Florida? Are we going to see a bigger shift in certain areas than we normally would see in a cycle because you've had people moving out of cities, you've seen people moving to second, third division cities? How is this cycle going to be different, considering that it comes on the back of the pandemic?
Well, look, we look at CPI data, actually, in that respect, and we see that owner's equivalent rent and rents are way higher in those areas that you mentioned, so in the South and in the West, whereas growth in the Northeast is way slower. So that tells you that, the migration from those large cities such as New York is still ongoing, and people who can work remotely, they still, prefer to live in other areas. So that structural shift is still with us.
Yeah, Drew, are we seeing the same thing on the company level, and has any of that truly been accurately reflected in valuations?
And so, going back to what Yelena said, there has been a structural shift in where population is going, and consequently where builders have emphasized their business. It's all in the Smile States in the South, the Southwest, and the West Coast. That's where you're seeing most of the growth. When we look at what markets, just going back to an earlier question, might be at most risk, where we're seeing the greatest slowdown right now is some of the southwestern markets. So think of a Las Vegas and a Phoenix. It's kind of those markets that you think about when they're leaders on the way up, but they're also leaders on the way down. These are some of the markets that have seen the strongest home price appreciation, and they're also the markets where now we're starting to see the largest build in inventory. So that kind of gives us a little bit of concern in some of those markets.
Guys, thanks a lot. We really appreciate you delving deep on this topic with us. We'll continue it throughout the show as well. Yelena Shilieva, Bloomberg Economics, and Drew Reading of Bloomberg Intelligence. Guys, thanks very much. Coming up, we'll take the market point of view. Greg Fleming, Chairman and CEO of Rockefeller Capital Management, will be joining us, and where he sees the fault lines in the U.S. economy. This is Bloomberg.
This month, as the world watches inflation rise, employment rebound, and fiscal policies react, all roads lead to Jackson Hole for the Kansas City Fed's 2022 Economic Policy Symposium. Bloomberg Surveillance is live as policymakers and financial insiders discuss the economic issues and solutions that keep the world's money moving. Coverage starts August 25th, only on Bloomberg Television and Radio.
Well, stocks a little mixed today. The Nasdaq 100 still down by about 0.6%. But over the last couple days, we're learning what the big guys are doing. 13F filings that came out Monday showed two billionaires taking some very different approaches to the market. Bloomberg Sonali Basak joins us with more. Sonali?
Alex, thank you so much because, you know, it is truly fascinating. We have Stan Druckenmiller's family office, Duquesne, for example, really getting away from big tech, selling hundreds of millions of dollars worth of stock, where George Soros, who we work very closely with, has been buying. And some of the most interesting and controversial names, Tesla, Alphabet, for example. But, you know, we have the perfect person here to talk to us about it. That is Greg Fleming. He is the CEO of Rockefeller Capital Management. You know, when you look at what your clients are doing, Greg, are they by the way of Stan Druckenmiller, or are they by the way of George Soros? Are they buying again, or are they shying away from the market?
You know, Sonali, I think cautious is the word I would use for our clients and our private advisors. There's a tug of war that's going on from a macro standpoint in the market, as you know. A month ago, there was greater concern over inflation. We get some good inflation data in the last few weeks, and now people are thinking, well, maybe the Fed pulls back sooner and we can get the soft landing. So because of that, you have exactly what's gone on here. You've got Stan with one perspective, and then George on the other side, because people are reacting on a real-time basis to the way the whole thing seems to be evolving.
To the extent that your clients are cautious, what are they most cautious about? Are they worried most about the Fed, interest rates, inflation, or global chaos?
Well, it's a great question because I would say to some extent all of the above. And the focus moves from one topic to the next based upon data that comes in. So literally a month ago, the biggest focus was on the Fed and the inflation numbers and the fact that the Fed was going to need to continue to move aggressively. Now, a whole bunch of people believe, with the data coming in the last few weeks, that maybe the Fed can actually land this without creating a significant recession, and they might pull back a little sooner. From my vantage point, I think the Fed's going to keep going now, having gotten a late start.
Greg, hi, it's Alex. Really great to see you. Thank you so much for joining all of us. To that point, we've seen, like, Bloomberg Economics here is looking at a 4% Fed funds rate. We've even had guests on that look at 5 or maybe 8%. What do you think? And then what happens to markets?
I think the Fed is going to keep going here. As I said, and Alex, we've been talking about this for a while. They got a late start. They're on it now. So I think that by the end of the year, they keep going 75 basis points probably in September, and they get to 3.5%, 4% by the end of the year. In every major tightening cycle that the Fed started since 1970, the Fed funds rate has gotten higher than the current CPI before they pulled back. So you've got Fed funds around 2.5 today, and you've got inflation, current inflation around 8.5. So those numbers need to get much closer together for the Fed to really pull back in our eyes.
So, Greg, to that point, it feels like that would mean a lot of market volatility. Do you think it's going to mean that this time? I feel like the market has been completely either not listening to the Fed or just straight up ignoring the Fed.
Well, you know, if you went back a month ago, maybe the market was listening to the Fed. They may be, you know, it's rallied significantly in the last month. You know, when you have these transitional times, Alex, where the Fed's trying to get inflation down, obviously they'd like to do that with a soft landing, but that's tricky and historically not happened a lot of the time. But when you're in this transitional time, market volatility is going to stay higher. So it's been a very positive month, but there's more volatility ahead. As data comes in and people react to it, markets will respond accordingly.
Greg, good morning. It's Guy. What happens to wealth in this environment? Wealth has been turbocharged, supercharged since 2008 with the arrival of QE. We're now in QT. How does wealth develop in that kind of environment?
Well, Guy, wealth over time is going to continue to expand as economies expand. So, you know, the wealth management market in the U.S. and around the world will continue to grow through the cycle. The cycle can obviously influence it in the near term. You know, for our clients, where they're putting a significant amount of their wealth, and remember, our clients are primarily high net worth and ultra high net worth investors, they've dedicated an increasing part of their wealth to alternative strategies where there's illiquidity in the near term, but they're investing in best-in-class managers through the cycle, so that what happens in the public markets is a little less relevant for them as long as they're in the right investments with the right managers. So we think alternative investments for high net worth and ultra high net worth investors will continue to be an increasing part of the equation.
Is QT a threat, though, to that wealth? We've had money creation, which is aggregated in the upper echelons of society. If we get money destruction, does the same thing happen in reverse?
Well, QT is definitely, and as you know, Guy, QT is really not kicked in yet. The Fed balance sheet is still close to its peak, and they are going to step it up from here. So QT will take liquidity out of the system. It will create, as a result of that, more market volatility, and it will suppress wealth in the near term. My only point on wealth through the cycle is that as economies grow and wealth is created, you know, the wealth management business does continue to expand. But I agree with your point. QT is going to take liquidity out of the system, just like it put liquidity in the system, as you said, on the way up.
I'm wondering how your clients are thinking about global investing at this time, because we had some really harrowing economic data out of China. We have a lot of concerns in Europe as well, and recessionary concerns to that end. You have a footprint in London. So how are your clients thinking about investing abroad? Is the U.S. the relative safe haven, or are they looking to diversify globally in this kind of new global paradigm we're looking at?
Shonali, there's no question that the U.S. is a safe haven in a lot of ways for a lot of clients, given what's going on in the world. I mean, it is an exceptional time in terms of the exogenous factors that are in the system. I mean, we've had a pandemic. We have a war and all the pressure on energy. We have the tension in Asia. So that does lead investors, high net worth and ultra high net worth U.S. investors, to be more inclined to invest in the U.S. at the margin. Having said that, there are still places and pockets of investment opportunity outside the U.S., and there always will be. But no question the last 2 or 3 years has created enough exogenous pressure to make the American market a safe alternative.
Not that the U.S. doesn't have its own challenges. You know, we're walking into a midterm election. What kind of volatilities does that create, and what are your clients hoping to see out of the outcomes of these elections?
Well, you know, what our clients are hoping to see is government that works and that gets things done to move the society and the economy forward. I mean, I think there's a lot of support throughout our client base and across the country for what happened with the semiconductor bill and bringing some of the manufacturing back on shore for these precision products and things that are important to the economic strength of the U.S. So I think, you know, clients are hoping to see that. The biggest risk from a volatility standpoint, though, Shonali, remains the Fed. I mean, the Fed, you know, these phrases have been around for a long time. Don't fight the Fed. They're in a significant tightening phase, and they may, to Guy's question, they're going to add quantitative tightening to the equation much more going forward here. So the Fed, even more than midterm elections and fiscal, is really the central player here.
Greg, in all of this, what is your objective? We're going to see turbulent times. It's going to be interesting to navigate. Rockefeller Capital, where's it going?
Well, our objective, Guy, is to continue to work with our clients on longer-term investment plans to make sure through our private advisors who we think are the best in the industry, make sure they're working with clients and adjusting those longer-term plans as necessary as the exogenous world changes. We've been at Rockefeller Capital Management building out our footprint, as we like to say, across the U.S., taking this iconic name and setting up operations in major wealth centers where we can, through these elite private advisors, begin to serve clients in communities across the U.S. So we're in 38 cities now, and we'll add some more like Charlotte and Austin and others to that puzzle, and we'll be working with clients who have needs for high net worth and ultra high net worth capabilities across all of those different offices going forward.
I mean, the reality is you've been adding a lot of teams across Wall Street. You've worked at many places before. You've brought on some of your former colleagues. So how significant can the hiring plan still get? You've already grown from about $18 billion in assets under advisory from when you started to more than 90 now. So what does the growth trajectory look like? Is it that fast in the next couple of years?
Shonali, we had a plan at the beginning when we started in 2018, and we're going to finish executing that. So we're probably halfway through putting this footprint in place across these major wealth centers in the U.S. So we're coming up on $100 billion-ish in client assets, and we'll keep moving forward over the next few years to get into the remaining cities that we think we can serve clients in, and finish putting the footprint in place. And then from there, we'll be servicing clients on a long-term basis through Rockefeller Global Family Office.
Incredible. The growth has been absolutely incredible. Greg, great to see you. Thank you for joining us. We really appreciate it. Greg Fleming of Rockefeller Capital, and of course, our thanks to Bloomberg's Shonali Basak. This is Bloomberg.
Amanda Gordon.
The Nasdaq 100 S&P trading a little bit heavy today, but what is up in the S&P are the retailers. Walmart, the best performing stock within there, up almost 6%, sort of dragging up a lot of the other guys like Target and TJX. Home Depot also doing well in its own right. We'll break this down more in just a moment, but for Walmart, talking about how the middle income and high income shoppers are now coming to their stores. That's also quite interesting. How sticky is that? What does that actually say about the economy? And is their beat, quote unquote, just sort of under-delivering, over-delivering and under-promising. They'll break that down in just a moment as well. And Home Depot doing not as terrible as we would have thought, despite the fact that traffic and how much people are actually buying is slowing down just a little bit. We're going to break this all down and how to invest with Stephanie Wisnick, Jefferies Senior Research Analyst. This is Bloomberg. About an hour into the U.S. trading session. Tech around the lows of the session, but volume super light. Bloomberg's Abigail Doolittle is tracking those moves for us. Abigail?
Well, Alex, yes, a bit of a mixed picture here with tech. The NASDAQ really underperforming, down about 0.8%. This has a lot to do with Apple and Microsoft and some of the other big techs. And of course, Apple, we have found out that they eliminated roughly 100 contractor recruiters, which would suggest in turn that maybe Apple is planning on hiring less, a very rare move for this company. On the other hand, you can see the Dow, which is an index we don't take a look at all that often, up ever so slightly. That has to do with the outperformance for Walmart, which of course put up a good quarter, beating estimates, of course, that have been lowered, I believe, 3 times, but nonetheless better than expected. Some hope around margins, but the Dow, of course, is equal weighted, so it is benefiting. As for Apple and laying off those contractors, let's take a look at what's happening relative to tech jobs being eliminated. So going back basically to the third quarter of 2020, as the pandemic was not such a bad thing at that point relative to markets, you can see roughly 9,700 tech jobs were eliminated, and then really kind of flatlining the first quarter of this year, almost 10,000, and now in the second quarter, more than 37,000 tech jobs have been eliminated. That's something to keep an eye on, really suggests what some of these big tech companies are seeing and thinking about the current environment. Also the current environment, housing housing. So, it's interesting. Housing, of course, we've had some negative data yesterday. The home builder sentiment index down for another month, the longest losing streak since 2007. Today, housing starts missing, coming in around 1.4 million relative to the estimate of 1.5 million. 1 million, that's really the dividing line. It's sort of the equivalent of 50 on the ISM, whether it's contraction or expansion. So it is expansion, but missing, you can see these these home builders, Toll Brothers, KB Home, Meritage, and D.R. Horton, all under pressure as there are signs of weakness in housing. And it's interesting that this is happening for home builders because there's still a very limited supply for existing homes. So some folks are a little bit nervous. And speaking of the idea that maybe we're going to see a little bit of a cooling off for stocks overall, this is the number of stocks within the S&P 500 above the 50-day moving average. It is above 90%. It's only been there a few times. And you can see, guys, the other times when it's been super high that it's tended to go back down. So it suggests that maybe some sort of either steady trading is ahead or some kind of cooling off is ahead for stocks.
Yeah, the home builders have had a tough year. They bounced a little bit recently, but it's been a tough year. The market was definitely front-running this narrative. Abigail, great stuff. Thank you very much indeed. Let's get back, talk more about what's happening with these retailers. Walmart surpassing Wall Street's lowered is important here, profit estimates for the second quarter. The big box retailer offering a less dismal forecast thanks in part to falling gas prices and expectations surrounding back to school. Stephanie Wissig, Jefferies senior research analyst, joining us now with her analysis. She's got a buy rating, $150 price target on the stock. Stephanie, I'm trying to think about how to sum up Walmart. Could have been worse? Is that the right way of thinking about it?
Yeah, I think it can always be worse than this kind of backdrop. But the good news is that they were seeing some strengthening in consumer behavior at the end of the quarter. They also saw some supply chain relief at the end of the quarter. So directional improvement on a couple of the key measures that give investors confidence, and certainly us as analysts confidence as well. At the same time, to their credit, and I think we need to see a lot of this from management teams right now, they're not extending too far. They're maintaining a very realistic approach to the back half. They know the consumer is still making discriminate decisions about trade out and trade down, and so they're maintaining their back half guidance unchanged. I think, again, at this point, that's very reasonable based on what we know about the macro and just the volatility in the consumer.
What I was confused about is just a few weeks ago, they give that profit warning and sort of tanks the stock again. What changed in the last few weeks? Like, did demand surprise to the upside? They mentioned very much that the middle and higher income earners are coming to shop at Walmart, or did supply pressures actually ease that much, that quickly?
Yeah, Alex, it's a great question. I actually think your question inherently answers the question, which is that the volatility in the backdrop is week to week. It is combat week to week on the part of the consumer making decisions and businesses planning for those consumer decisions. So what changed ultimately was the relief in fuel and some supply chain improvements. So not so much of a change in consumer behavior or action, although a bit of strengthening. They did mention at the end of